Hi everybody, Spartan here from SpartanTrading.com. Today I want to go over the basics of moving averages and how to set up your charts for trading, day trading specifically. So let's talk about the moving averages and how they work, and let's talk about setting up your charts for day trading. Now, when you're day trading, you're typically going to be using an intraday chart, so a chart that's open from 9:30 in the morning till 4 o'clock Eastern time. So that's the time frame that we're going to be looking within primarily. And you're going to be going with time frames between 1 minute to about 15 minutes, in my opinion, is the best to be using for intraday trading. A lot of people like the 1 minute chart because they can see specifically where to enter the stock when it does break certain uptrends or downtrends. In this case, let's just go through a little quick example. Stock is trading in a little bit of a downtrend. It breaks that downtrend right there. You can look to get into the stock there for a little bit of a pop-up. I typically don't like to use the 1 minute chart. I like to stick with a little bit of bigger time frames, 5 minute, 10 minute, 15 minute. Why? Because when you do get these trend breaks, they tend to give you bigger price movements. And the bigger the trend break on the larger the time frame, the bigger the price movement's going to be. So I figure if I can wait for a downtrend break or an uptrend break on a larger time frame, the movement's going to be bigger, so it's more worth to play, in my opinion. So that's, you got to decide what type of trader you're going to be intraday. I like to hold things, throughout the entire day. I try to look for multiple points of room to the upside. You may be someone who's looking for just to make 20 to 30 cents per position. It all depends on kind of the time frame that you're looking at. That's going to dictate how long you're going to hold the stock. Typically, the larger the time frame, the less volatility you're going to see on the stock. It looks a little bit cleaner in terms of, for this case, you can see a clear uptrend on the stock here. And if you looked at the 1 minute chart, it's a little bit harder to see that uptrend as clearly. So I tend to gravitate towards the a little bit bigger time frames intraday. So you got to choose what type of time frame you're going to be based off of the type of intraday trader you're going to be. And to set up your charts, some basics that I think every day trader should be having on their charts should be the volume. So basically the volume that is coming in and out of the stock, buying and selling volume. So I'm just going to add that here. And on the volume, I'm just going to make sure that the ticks match the actual candles so I can see when they're buying and selling. So I think it's very important to have the volume. Obviously, basic economics, if there is a certain amount of supply, in other words, there's a certain amount of stock available, if you see demand coming in or buying, then that should push up the price. And then vice versa, if there's a certain amount of supply and you see selling coming in, that should decrease the price. So by having the volume up, we can actually have a visual indicator when that buying is coming in, which should push up the price, or when that selling is coming in and which should pull down the price. So we got some, basic indicators here. The volume, you can see the selling's coming in here, and you can see the chart starting to pull back, pull back, pull back. One thing to note is as the volume increases, we should see the stock push up more, because as volume is increasing, demand's increasing, which means that the price should be pushed up more. So that's just a basic that we should have up on the chart, and it's something to note throughout the day, whether you're looking at, a 1 minute, 5 minute, 10 minute, 15 minute chart for intraday trading. Another thing I want to quickly talk about is the basics of EMAs and SMAs, aka the basics of moving averages. I think the two we're going to stick with today are just simple moving averages, which are SMAs, and EMAs, which are exponential moving averages. And I just want to give you a quick overview of how they work. A simple moving average is a moving average that acts as a general support or resistance. So based off of the amount of time you're going to be looking back on that moving average, so let's just bring one up and then we'll quickly go through it. We'll bring up two. So one of the most basic moving averages that a lot of people use is the 20 SMA, or 20 simple moving average. So this takes the moving average across the period of 20. If you were going for something a little bit bigger, another basic would be the 50 SMA or the 50 EMA. In this case, I'm going to go with an EMA on this chart for the 50, and we'll keep the 20 at a simple moving average. And let's explain how they both work. We'll make the 20 SMA blue, and we'll make the 50 EMA red. So, simple moving averages, which in this case would be the 20 SMA, act as more of a general area of support and resistance. The way that moving averages work is when the price is below a moving average, like it is here. When the price is below that 20 SMA, this moving average will act as resistance. So when the stock pushes up into that level, you're going to see people selling into that moving average. When the price is above that moving average, you're going to see people buying into that blue area, which is the simple moving average, because it's going to act as support. So basically, when the price is above a moving average, it acts as support. When the price is below a moving average, it acts as resistance. So there's the 20 SMA. The 50 EMA, which is this blue line here, acts as more of an exact area of support and resistance. So where that 50 EMA is, that exact area is going to be a resistance point on the chart. You're going to see stock traders sell into that area or buy into that area depending upon if the price is above or below that area. So you'll see, here you can see people selling into it. Here you can see people buying off of it. Are these moving averages always going to hold? No, they're not going to always hold. But for majority of the time, they will. So it's just something to note when you are starting out. You can have these indicators up to help you buy off a support level or sell into some sort of resistance level. One of the things that a lot of traders use these for is they look for prices crossing those moving averages either to the upside or the downside. And when you say the price crosses the upside, when the price crosses these moving averages to the upside, we know that they become support on the downside. So these are now support levels that we can be buying off of. It can give you a kind of a indication of where the price is going. Price crosses a moving average to the upside, we can say that, okay, the stock is looking more bullish, so it looks like it's going to go up higher. If the price crosses a moving average to the downside, we can say, okay, it's looking a little bit more bearish, or the stock's going to sell off a little bit more. So these are just some basics I wanted to go through with you guys, basically setting up what type of charts you're going to be using for day trading, going through the basics of SMAs and EMAs, because over the course of trading, you're going to be using a lot of different ones, and you've got to find the right ones that work for you. So that's all I wanted to go through today, guys. I hope you have a good rest of the day. If you're interested in checking us out, you can click on SpartanTrading.com into the description there. Live chat room is where we do all of the day trading. I give live guidance and ideas throughout the day to help traders grow and to help traders within positions or enter positions at the right areas. You can check us out there. Any questions, you can email me at spartantrading.com. Thanks for checking us out, guys, and I hope you have a good rest of the day today.